Finance Twitter Spaces. Before we dive in, I would like to take a moment to wish all the teachers and mentors out there a belated Happy Teachers' Day. Your dedication, wisdom, and unwavering support have been the guiding light for many of us, leading us towards a brighter and more informed future. Today, we are privileged to have a personal finance experts with us who will share invaluable money lessons. These lessons aren't just about numbers and figures. They're about securing your future, making informed decisions, and understanding the value of every rupee. To take this discussion forward, joining us as co-host Akhil Rati is a VP Financial Concierge at One Finance, and along with him we have Animesh Hadia, SVP Quantitative Research at One Finance. And joining us as speaker, we have Keetan Shah. He's a CEO and co-founder at FPA EduTech. He's an entrepreneur running businesses in the area of financial planning and education with a decade of expertise in sales, training, and consulting. He brings good exposure to banking, treasury management, and wealth management also. Thank you, Keetan sir, for joining today's One Finance Twitter Spaces.
Hey, thank you so much for inviting me.
Along with him, we also have CA Neeraj Dugga. He is a partner at Holistic Wealth, a CA with 10 plus years of experience in the financial service industry and insurance advisory. Neeraj has previously managed audit and assurance services for one of the big four accounting companies. Akhil sir, I would like you to take over from here.
Thank you, Akash. Thank you, Kirtan. Thank you, Neeraj, for joining on this evening. So, as Akash told about, like, belated Happy Teachers Day to all the mentors, to all the experts we have on this spaces. So, basically, it is true. It is very true that, like, in terms of our education, in terms of the lessons we have studied in our schools and colleges in terms of personal finance, in terms of money lessons, we have not gone into deep dive, we have not done a deep dive in terms of personal finance lessons and all, and all over the world, as well as in India also, education systems, we have seen less amount of sessions in personal finance. I think Neeraj, can you please mute your mic?
Sure.
Some disturbance is coming. Yeah. Yeah, thank you so much. So we have seen that due to the absence of personal finance education, we have seen that it is impacted on individuals, families, as well as overall society. And in terms of consequences, we have seen low financial literacy, high levels of debt, stress, as well as scams. We have seen economic impact. People don't know about personal finances and all. So but now today we have two speakers, like one from the education industry, one from the financial planning industry. So we will be listening to them in terms of like what are the important lessons every individual should involve in their personal finances and all. So like I won't take much time in terms of like my gyan on personal finances. We have today two important speakers, Keetan and Neeraj. So my first question to both the speakers is like anyone can start. Like what are some foundational lessons everyone should know about financial planning? And especially I would say the person who individuals for late 20s and late 30s, like some foundational lessons. Yeah. Keetan, yes, you can start. Yeah.
Okay. Hey, I think first of all, thank you so much for having me on the spaces. Yeah, thanks.
Yeah.
Uh, I think a couple of
Yeah.
things from my end. I think financial planning is actually not about generating higher returns. Uh, Financial planning is actually a process in which anybody who's guiding you wants to understand who you are, what are your requirements, and then following that process, the person helps you reach your goals. That is financial planning. It's not about picking the right stock or investing in the best mutual fund. Of course, that is one part of what financial planning is, but financial planning definitely is not to generate higher returns, right? Now, all of us know that starting early is so important, but it's always in the hindsight, because in early 20s it's all about maintaining a lifestyle. But I think, and because you specifically mentioned about the early 20s and 30s, and I'm saying this, Financial planning actually is a process that helps you understand the advantages starting early. Because unless you don't understand the advantages of starting early, you will probably in your early 20s, late 20s, or early 30s spend a lot of money away in maintaining a lifestyle which actually can compound over a period of time in a great deal. Because what typically financial planning will help do is bring in a lot of discipline, help you understand your requirements, by which kind of reduce your unnecessary expenses and increase savings or investments. And also it typically makes sure that your risks are covered, like it is very specifically said. And I see a lot of people quoting this, that in India you are just one hospitalization away from bankruptcy, right? So while in early 20s or 30s, if you understand the importance of risk management or probably optimizing your tax, because today also what's happening is investors, in the name of saving tax, invest in an insurance product or a 5-year FD. That's actually not tax optimization or trying to save tax. What typically financial planning does, at least the way I look at it, is it helps you understand the difference between your actual need and your unwanted desires. So that's I think what my foundation understanding would be about financial.
Yes, very rightly said. Like in terms of like we have to differentiate what need we have, what want we have. Yes, Neeraj, please go ahead.
Yeah, so I'll just take over from what Kirtan was saying, right? Basically, see, there is a very big debate there whether should people start focusing on personal finances early in their early 20s, or should they, not save much money and spend almost of it on upskilling and creating experiences in life, right? So my view, especially for those in their 20s, is right. One should definitely spend money on upskilling themselves, because the people, the income at which you start, you will probably not be able to save a lot of money anyways, right? So it's always best to invest in upskilling yourself and focusing on increasing your income. But having said that, certain things are very important here. Number one is building a habit of saving and investing money, right? If you don't do that in your 20s, if you don't start early, what is going to happen is even in your 30s, when your income is high, you will always think that I will start later, but that day will might not never, ever come. And secondly, it's always see, if you start working with a financial planner in 20s, the financial planner will probably ask you to not do a lot of things, right? Like say not trade, or invest in riskier fixed income products and all that. Especially with all the noise that we have on social media today, it's always early to better to experiment early and understand all these different products that are out there in the market, and understand what kind of risk is involved in each product, right? So basically, one should start putting things on this spectrum of risk, right? From what is the least risky to the most risky, so that once they can understand all these things in their early 20s and probably also work together with the financial planner, then that's would always be best for them. But the focus should be in 20s to at least understand risk, understand different products in the markets, and how understand how long-term investing works, provided you are able to take care of the basic risk management in your own personal finances.
Yeah, yeah, you correctly said, like in terms of like if someone is experimenting, if someone is looking out for different financial products, but discipline also plays a very important role. Like I have seen many people, like if someone is in the early 20s or late 20s, if they like crypto, they invest only in crypto only, or they invest only a single asset class. So discipline plays a very important role. So my next question to both of you, like in terms of like financial planning, since we look out like financial planning at One Finance, we look out from the holistic point of view. Like Kirtan, like since you are educating the young people in India in terms of like CFP courses and all, so like generally I have seen that many advisors focuses on only investment planning. They say investment planning is the financial planning. So like how, like what are the common misconceptions like going in the industry in terms of about financial planning, and what is the right approach according to you?
Okay, I think that's a very important point that you've raised, because look, financial planning is not about only investment planning. And like I also mentioned in my first answer, the financial planning is not a way to generate higher returns. It's the way for you to reach reach your goals. Financial planning ideally is actually a 5 6 step process where first you actually collect the right kind of data from the client to try and understand who the client is or the investor is. You try and do a risk profiling to try and understand whether the client or the investor is aggressive, moderate, conservative. Once you've understood this background about the client is where you try and understand what are the goals that the client really has, and how do you help the client reach those goals, right? Now this is one broader prospect of what financial planners should typically do. But along with this, you probably might have so many things that you have to take care of in a financial plan, like goals is one that we spoke about. You will have to make sure that the investors tax is rightly optimized. You are helping the investors save taxes in the best possible way. You are also kind of making sure that the risk management at the client's end, which is let's say life insurance or mediclaim or anything, is optimized properly. And very importantly, um, the investor understands the importance of estate planning, writing a will or a trust. All of these things put together is actually what a financial planner does. The financial planner does not only help you generate higher returns. It's actually a 5 6 step process which covers all of these things that I spoke to you of, right? But unfortunately, in today's digital world, I think the conversation only revolves around returns and performance and product selection, which probably is a part of financial planning, but I think it's a smaller part. The larger part is making sure that the risk management, the estate planning, the goal based planning, and all of these things, or tax optimization, it's a bouquet of things that the financial planner actually takes care of, and not just investment planning. Okay.
Yeah, so like generally, like I also say to all my members, like all customers of One Finance, also like even to my friends and all, like if you look at financial planning, investment planning is just 10 to 20% of the overall financial planning. So don't just focus on investments and all. So Neeraj, like since you're a chartered accountant, like you have an expertise of tax and all. So what is your view? What is the right way for financial planning?
So, see, the most common misconception that we have seen, among all the people that have approached us is that they think that a financial planner, financial advisor is meant to generate returns for them, right? And other aspects which all of them that Kirtan mentioned are forgotten, right? So when anyone comes to us, how much returns will we get, right? Which fund should we invest in? That is the question. And the question does not revolve around, okay, how should I cover my risks, right? Or how should I optimize my taxes, right? For example, say an employer's contribution to NPS is something that most people are unaware of, that once employer contributes 10% of your basic to NPS, a lot of taxes can get saved. So certain such things are missing. The awareness is missing among people, even among employers, right? And employers are also very lazy to implement these things because it requires effort from their end. There's no cost, but there is only effort to implement these things, right? So our goal as advisors is to make sure that we are doing a holistic review of everything and providing a complete guidance. The returns obviously follow once you start following the process that is set up for the clients.
Yes, yes, like you correctly said, holistic financial planning is the correct approach. So now, since we are talking about holistic financial planning, now let's get into a deep dive into like what are the important components of a holistic financial planning. Like since we are talking about investments also, so let's start with investments. Like my next question to Kirtan, like how can like an individual align their investment strategies like with regards to their short term and long term goals?
I think, Akhil, the answer to this question is asset allocation, in my opinion. And while all of us know that there are so many of these sample risk profilers and all available on the internet, which kind of gives you a broader understanding of whether you are an aggressive, moderate, or a conservative investor. I think one very important point while we look at asset allocation is time. And the reason why I say time is to specifically answer your question of how do I take care of short term and long term goals both. Like, say, for example, even in the most aggressive clients, right? I don't think you would want to stay invested 100% in equity if your goal is just 1 year away, right? Or the other way around. Even in the most conservative investor, you would not want not to take exposure to equity if your goal is 30 years away, right? So I think time plays a very important role in terms of asset allocation, which is my answer to how do you manage investment strategies in the short term and the long term. So to not complicate it, let's say if I have to make this simple, I'm saying if the goal is less than 1 year, right, then typically you should stay invested in debt, right? Which means that, let's say, even if you've invested in a longer term goal, right, and your goal originally was 15 years, now you are at the 14th year or the 13 and a half year, and now you know that my goal is just 12 months or 18 months away, you start moving from equity to fixed income because you don't want a lot of volatility when you are closer to the goal, right? So when your goal is, let's say, just a year away, right, then you should have higher exposure to fixed income. But let's say if your goal is 1 to 3 years, still I'm not very confident that 3 years, less than 3 years, is the right time frame to have a lot of allocation to equity. So I would say if your time horizon is anywhere between 1 to 3 years, look at hybrid kind of products to invest in. Let's say a balance advantage fund or something like that. Right now, if the goal is above 3 years, is where you introduce equity, depending on what your original risk profile was, whether you're conservative, aggressive, or moderate. So if you're moderate, then you might have a 50% allocation to equity. If you're aggressive, you might have 70-80% allocation to equity. But I'm saying that while you might have short term, long term goals, your strategy in short term and long term will largely depend on how far is your goal. I hope that helps the listeners.
Yeah. So since you're talking about like equities more than 3 years, so I was looking at mutual fund redemption data last month, and one of my colleague have published on social media also. Like in terms of redemption, like more than 90% of like individuals have withdrawn their equity investments, like mutual fund investments, within 5 years also. So since they're investing for long term, like more than 5 years, 7 years, as well as 10 years, but they're withdrawing within 5 years. So it is impacting the cash flows as well as the returns also. So Neeraj, like for for an individual, like choosing a financial products between equity, between debt, between real estate, like what should be the right strategy? Like whether he should just go with the book rule of 50-30-20 or 100 minus equity. What should be the right approach?
So, Akhil, having a clarity on your financial goals is the most important thing here, right?
Mhm.
Because, say, a 25-year-old comes to us and he wants to do financial planning. For him, the most important financial goals would be, say, maybe paying off his education loan or getting married in the near term, buying jewelry for marriage. So could be these things, right? So if the goals are these, then you can't really do any sort of asset allocation for him, saying that okay, the thumb rule says that 50% should go to equity, so we'll invest 50% for equity into equity, right? So that's why, in such cases also what happens is that people should focus on having a balance between, say, liquidity, tax planning, and all that. Sometimes it may also happen that you have to pay a little bit more tax just so that you have a little more money in your hand, right? Say, instead of contributing 12% to EPF, you may have to contribute 1800 rupees to EPF, just so that it will, let you have more money in your hand so that you can meet your near term financial goals. And then the changes can be done as those financial goals are through, right? So it's all about having a clarity on the financial goals and then planning accordingly.
Yes, clarity on the financial goals plays a very important thing. So my next question to both of you, very importantly, like since we have talked about investments, so liability planning also plays a very important role in terms of overall financial planning. And we have seen nowadays so many lenders are available on our mobile, and we can get a loan of any amount within fraction of seconds and all. So like Kirtan, I wanted to start like you can start like what is the best strategy in terms of for liability management, and how a person can build assets using liabilities.
See, I think there are two, three points that I would like to highlight here. I personally follow this rule, and I typically suggest people to do this. Where for me, while you are taking a loan, irrespective of how many ever number of loans you've taken, the idea here is to make sure that the EMI that you are paying should not exceed 30% of your income. I think this is the first rule that I typically suggest any and everybody who intends to take liability to keep in mind. Because if you start going way beyond this number, then over a period of time, it actually becomes extremely difficult for you to be able to service this. And we saw a lot of these things happen during COVID when people started losing their jobs and stuff like that. So first is to make sure that your EMI is in total, try it not exceeding 30% of your income. And also always try and make sure that you have an emergency corpus in place, that if at all there are some cash flows issue, I think you should be able to manage for 2 3 4 months, right? But very important is that if you've taken multiple loans, right, make sure that you list down all the debt that you've taken, you list down all the tenures of these loans, you list down at the rate at which these loans were available. And whenever you get an opportunity, because you probably would have saved some cash or you would have got a bonus or anything, try paying off the debt which has a highest rate and the longest pending tenure. Look, the logic is very simple. When you say the highest rate, you don't want to pay higher interest, right? But the reason why you should pay off the longest pending tenure is because very early in the loans, when you are paying EMIs, you are actually paying interest more and less of repayment of principal. So when you know that you have 4 loans outstanding, the best way to pay off is the loan which has the highest rate and the longest pending tenure. And also, and I've seen a lot of clients of ours also do this because this works, is whenever you feel that the rates have aggressively moved down, right, call your bank up and tell the bank that you are going to refinance and you are getting a much lower rate from somebody else. Doing this actually gives you a much lower rate from your existing financer, and that's how you can kind of reduce your liabilities or EMIs. I think these are 3 4 things that have practically worked for me or the ecosystem. And I think these are some things that definitely somebody or anybody listening to us having liability should definitely think around, because it'll add a lot of value to them. I hope that answers your question, Akhil.
Yes, yes, like you have given a strong points in terms of liability management, and I have seen like many cases like people for their lifestyle to improve their lifestyle, they take liabilities to show off like between friends and families and all that. But finally, what is impacting the cash flows is impacting. Neeraj, your view on liability management and how one can build assets using liabilities?
So on liability management, right, we've seen people having expensive loans and also simultaneously investing in equity mutual funds or fixed income products, right? When your loan interest rate is in double digits, it always makes sense to pay off the loans instead of, you saving money to invest, because the loan itself, nothing, say, for example, take equity as an asset class. If you're investing in equity, do you think that it will generate more than 12 to 14% over the long term, whereas your loan is at itself is at 15 16%, right? So it's always better to pay off these loans instead of investing money on the side, because we have seen a lot of such instances. And then like Kirtan said, listing down all the loans and their tenures, and paying off the most expensive loans always makes sense. And as far as taking a loan to buy assets is concerned, again, the difference, you need to differentiate between which asset you are buying, right? Are you buying a depreciating asset or an appreciating asset? And then then say for example buying a car versus buying a house, right? So the mathematics completely changes based on what you are buying, at what valuations you are buying, at what rate you are buying, right? So some people buy land or buy under construction property, and they may not get a home loan, they may all get a personal loan, right? So all these things need to be factored in. So it's always better to talk to someone, talk to an advisor, and see if you're taking the right steps before even getting into the game of borrowing money.
Yeah, very importantly, like how much liability one can afford in terms of like paying EMI as well as from the overall assets point of view. Okay, so we have completed the first half in terms of like discussing about investment planning, liability planning. Now the second half will be taken by Animesh. Animesh, can you please?
Hey, Akhil, thank you for
Yeah,
handing over. So
thank
I
you.
know we were just discussing about loans, liabilities, interest rates. I just wanted to mention one recent RBI guideline which came out around mid of August, which kind of asked banks and NBFCs, that is all regulated entities, to kind of give personal loan borrowers an option to switch over from a floating rate loan to a fixed rate loan at the time of resetting interest rates. And just for everyone's information, whenever our central bank reduces or increases the interest rates, um, simultaneously the interest rates on loans can go up or down. Um, However, this was kind of an opaque process up until now, but the central bank kind of asking uh, central bank sorry yeah, the central bank asking all regulated entities to kind of inform the customers in a more transparent way. That's definitely a kind of guidance in the right direction. So one other thing that will happen going forward is whenever banks are increasing the interest rates on your personal loan or your housing loan, you will also get the option to choose between either extending your EMI tenure or increasing your EMI accordingly. So now more things are under customers' control. So that's definitely a very good positive development that has happened over the last 1 month. Um, I would now like to switch over the topic from slightly from loans and liabilities to um, kind of discuss more on expenditure patterns of people. And I would like to start by just a quote from James Frick. He's an American author. um, don't tell me where your priorities are. Show me where you spend your money, and I'll tell you what those priorities are. So, the reason why I quoted this is because people frequently kind of fail or find it difficult to differentiate between what their needs and wants are when it comes to household and lifestyle spending. Just for our listeners, household spending is more related to your daily household activities, your rents, your expenditures on groceries, fuel, transportation, etc. And lifestyle spending is more related to, let's say, going out for movies, date nights, traveling, etc., etc. So I wanted to ask our speakers on some practical tips on how people can learn to differentiate between needs and wants with respect to household and lifestyle expenditure, just so that people become better at maybe expenditure planning, budgeting, etc. Kirtan, can I ask you to go first?
Hi, Animesh. Animesh, I think the investors actually know the answer to this question. 9 out of 10 people that we will talk to, they will know the difference between need and wants. I think it is just a behavioral uh, gap that does not allow them to control their wants, right? I mean, example from a goal perspective, because we've been discussing about goals since the start. I think, let's say, a retirement planning or an education from a broader perspective, maybe a want for most investors, but marriage can be aspiration, right? Or marriage can be a want. So while you have retirement and education as a need, sorry, I'll rephrase that. So while you have retirement and education as a need, you might have marriage as a want, and most people understand this. And so, like I was also answering in the liability discussion with Akhil, I think most of us should make sure that we follow some rules, so that we know when we are crossing our line. Like, say for example, we were discussing in liabilities that probably, for me, I would want to be in a situation where even if I've taken a liability, all my liabilities put together, my EMI cannot cross 30% of the income that I make every month. Right now that this rule is set, I would immediately know as soon as I cross this 30%, right? Or say for example, if I have to buy a car, I will not buy a car more than 3 to 6 months of my income, right? Now when I set that rule, I very categorically understand whether I am exceeding my need, and am I moving to wants or am I not? So I think largely 9 out of 10 people that we talk to, largely I would like to believe that they understand what actually their needs are and what they are wanting over and above their needs. It is just that behaviorally they are not able to control themselves, and hence such rules that I just spoke of may really help them understand if they are really within the limits of crossing the barriers.
That's a very practical tip. I mean, the biggest part is behavior management. And I mean, what's better to kind of manage your behavior better than to set actual practical quantified goals so that it becomes easier to control yourself from crossing that threshold. Neeraj, the same question to you.
So I have a very simple strategy, right, when it comes to spending money on wants in our family, right? So what we do is we have, see, again, needs will differentiate depending on your family's finances, right? Your family's income, your family's net worth, and all that, right? Say, for example, uh, my family can probably afford having a full-time house help, but another family cannot, right? Because their income does not support it. So it may become a need for us because if we have a house help, we can focus on other things and probably focus on increasing our income, right? So firstly, you need to really understand what exactly is your need and define that. Once you have done that, then what we do is we have a budget for our monthly fixed costs, and then we focus on then I focus on how much should we invest on a monthly basis. Once I have invested every month out of my income and spent money on fixed costs, over and above that, wherever I spend, I'm not much concerned about it because it's coming out of my income and it's a want, and obviously it's a discretionary expense, right? And if since I'm running a business, and if any month my income is going to be say lower than last month, then I can manage my discretionary spends, right? This becomes a problem when you start borrowing money and create EMIs, right? Because then that EMI becomes a fixed cost for you. So as long as you're not creating your EMIs, you're good. And we don't really have any EMI apart from a car loan that we have in our family. So I think it's very one must focus on firstly defining what exactly is your need, because the need itself will differ from household to household.
That's very true. And I think the one really sticky point that you mentioned is never spend your money before you actually earn it. So avoid taking loans or liabilities for your wants. And the second dimension you added that, hey, look at your income level and then take a decision about needs and wants. As your income level grows, definitely some of the things that you previously thought were aspirational may actually become your needs. For example, maybe after a certain income level, shifting to organic food which previously would have been costly to you, right? So that move shifting to organic food may become a need. So definitely focus on your income before looking at your expenditures. So Neeraj, again, my next question to you is since you kind of spoke about NPS as a very good tool for taxation. So my question is, can you share some um, tax planning strategies that can serve dual purposes, such as reducing the tax liability and also serving as good investment option for the long term. I know your recommendation on NPS is definitely something that can save a lot of tax, but I'll let you
Yeah,
comment on.
so not a recommendation, but you need to take it from on a case-to-case basis. But yes, NPS, especially the employer's contribution part, wherein you can contribute 10% of basic salary, definitely saves a lot of tax, specifically for people in the high income and high tax brackets. Obviously, there is a ceiling of 7.5 lakhs there, so you need to you plan it in a way wherein this does not exceed 7.5 lakhs in a year. And then a couple of more things where one can focus in terms of meeting their investment needs and also tax planning is public provident funds and employees provident funds, right? We've seen that a lot of people don't really contribute 12% to employees provident fund, and they're only contributing 1,800 per month. So considering the balance between liquidity and all that, the very fact that if your employer does not have the option of NPS contribution, but if you can increase your employer's contribution to employees provident fund from 1,800 to 12% of basic salary, that itself can save you a lot of tax. And these investments, the public provident fund and employees provident fund investments, can become a core part of your debt investments as well, right? So you need not really invest in other debt products if it meets your asset allocation requirements.
And you answered my next question, which was on like how to approach your employer about NPS and kind of reaching that limit of 10% of basic or 12% of basic. So it all depends on whether the employer has that provision or not. But if it is available, then it is definitely something that
Yeah,
salaried
but
people should
most
take
times,
advantage of.
yeah. So what we have also noticed is a lot of employers are either unaware about it or are unwilling to implement it, right? So if employees as a group push them, they can definitely implement it. And we have actually gotten this implemented with a couple of our clients' employers as well.
That is interesting. And that would be a nice way to approach that. Definitely. Thanks, Neeraj, for that. Ketan, do you have any additional points?
Hi, am I audible?
Yes, you are.
Hello.
Yeah, yeah.
No, I think Neeraj has very beautifully explained two of these things that even I was thinking about discussing in this discussion, which was the employer provident fund and the NPS. I think the biggest challenge with NPS theoretically is that a lot of us, kind of think of the compulsion, annuity, illiquidity till retirement as one of the reasons of not doing this. But I think it's a very interesting option available for most of us to consider and shouldn't be ignorant towards that. So I think I was also supposed to talk about NPS, EPF, and largely ELSS because typically still there are a lot of investors outside of the Twitter community who still, like I mentioned earlier, also look at the 5-year fixed deposit or an insurance product to kind of save their ATC, right, which probably might help them in saving the 150,000 on the ATC if they're choosing the older tax regime, but that primarily may not be the right kind of investment, or there are better opportunities that you can do. Or all of us keep discussing about how an ELSS is far superior than a PPF, but depending on the risk profile which we've been talking about, for a lot of investors PPF may be a far better option than an ELSS. So I think all of these options available, from an ELSS to a PPF to an NPS to an EPF, all of these are great options depending on your background and your risk profile and your investment horizon, Animesh.
And that's a great point. Understand the characteristics of the financial instrument before outrightly deciding what tax saving instrument you want to go into. So my next question again, Kirtan, can I have you first talking about this because you mentioned, you made a very great point that we are all one event away from kind of suffering a big financial loss because of some medical emergency, uh, uh, because of not having insurance, etc. So, my question is, what are the key elements to consider when choosing an insurance plan, and how does it fit into the broader financial plan?
Uh, uh, Animesh, like I mentioned earlier also in our discussion, for me, risk management is far more important than investment management, because imagine a situation where you've been doing SIPs for 3 years, 4 years, 5 years, and you've accumulated some corpus, and you have one risk that takes place either on your health side or the other way around. You probably might lose everything that you've accumulated over the last 3 years, 5 years, right? And hence I always keep telling people whom I interact with that, take care of your risk management first and then look at starting to invest. So for me, risk management plays an extremely important role in the entire financial planning process that we are discussing about. uh, I mean, if I have to talk about term insurance, let's say, or life insurance, I don't think any of us largely requires anything outside of a term insurance, right? And within term insurance also, there are multiple structured products offered to you where you pay for lesser term and get covered for a longer term, or you get all your premiums back if nothing happens to you at maturity. I think none of us need all of those products, because if you do math around it, you will understand the most simple, plain vanilla term insurance product is actually the best product to invest in. Now, while I have to decide between multiple insurers, which one do I take? I think there are two, three very simple data points that you look at. I would rather prefer going with an established name, right, like an HDFC or an ICICI or even an LIC, even if it is slightly costlier, then going for names that I'm not really very comfortable with, does not have a very long history, just because they are paying me, just because they are giving me lower premiums, right? Another thing, and we are talking from a retail standpoint, so that after hearing us they can do this, and hence I'm trying to give very basic stuff. You can also look at something called as the claim settlement ratio. Now please understand, so first, what is claim settlement ratio for people who are hearing us? Let's say if any insurance company has a claim settlement ratio of 90, it typically means that they are paying 90 claims out of the 100 claims that came, right? So I'm sure everybody understands that the higher the claim settlement ratio, better it is. But the bigger problem with claim settlement ratio, which is slightly more deeper, is that claim settlement ratio is done on the number of claims paid and not the quantum. So what a lot of these insurance companies do is they might reject, just theoretically trying to help everybody understand. So even if they reject a very high claim, right, and pay the smaller 99 claims, their claim settlement ratio will still be 99%, which may look good, but at least theoretically it at least gives you a heads up when you look at the claim settlement ratio. And if you see a number upwards of 94, 95 and all, right, you know that the claims are paid. But I think the uh, one other thing to do in this digital world is, read reviews on the internet. Now I know this is not a very financial planner reply, but because we are talking to individuals, retailers, and they have to do a DIY, right? For them, a good option is to go on the internet and check what reviews have these guys got in terms of claim settlement. But none of these things will actually fructify if, as somebody who's taking an insurance, you don't disclose the right information, which is a big problem. For a lot of us who try and save a little premium, we try and not disclose the right things. I think that is the first thing we as individuals should understand not to do, which is the right thing in terms of moving, or which is the right direction to move in, before even deciding which insurance company do I really want to take up. So yeah, those are a couple of things that I think are practically doable in the real world.
Thanks, Ethan. Some very practical points. Brand establishment, how long it has been in the market, because you need an organization which is going to be there when your family actually needs the claims. Then how well it settles the claims, that is the claim settlement ratio. And definitely, like you mentioned, maybe just browse on the internet, on social media, how people are reacting to that brand, or are there any existing complaints against that brand? So some very practical points.
Actually,
Um,
Animesh,
Neeraj,
sorry, I don't
sorry.
remember the name, but there was a very interesting post that one influencer on LinkedIn had written about her 1 year or 2 year or 3 year old daughter being hospitalized, and some company was not making the claim and all, and then the CEO, because of the social media presence, came into picture and then settled the claim. Now those
Yeah,
are the
this
kind of
happened two
example.
weeks back.
Yeah, those are the kind of example which will actually tell you and give you a very ground level feedback of whether or not, just to save a little premium, should you really move to those kind of insurers.
That's a very valid point.
Sorry, over to Neeraj.
Yeah, so I think Kirtan has covered everything, but a couple of things on risk management that people don't really, tend to understand is there, especially when it comes to insurance, right? That you will get insurance when you are healthy. You will not get insurance once you have been diagnosed with a certain disease, right? Or you are, say, obese or overweight. Even then, it becomes difficult to get an insurance. So you are buying insurance to protect yourself from any sort of future issues that may happen and that could you know land you up in trouble, either in the form of hospital bill or death, right? So that's why it's always important to understand that buy insurance when you are insurable, buy the best, and buy for till you want the cover. Say for example, when it comes to health insurance, probably most of us need it for the rest of our lives, because no matter how much we earn and how much our net worth grows, we'll always not want to pay the hospital bills, right? And someone else can cover it at a very low cost. Why not have that health insurance? But then this becomes very important, especially in the early years when you don't really have any sort of net worth, and your savings could get blown up in just one hospitalization, right? So better to, and also another thing is that people think that just because their employer has provided them insurance, it's good enough. But they need to understand that this is just a perquisite that they have given to them, right? The employer can change the product itself in the next year, or modify the terms and conditions depending on the premium that he has to pay in the next year, if it fits his budget or not. So these things are very important, right? So buy insurance when you are insurable, because you not get it when once you have issues, either any diagnosis or obesity or any other thing.
Yeah, building the right foundation is the first step before you can actually progress in life. And hence, like Kirtan and Neeraj clearly mentioned, risk management via right usage of insurance is very, very important. So please, please, please don't be penny wise and pound foolish by saving up on premium amounts. Uh, if you can, then do pay that extra premium for getting into a contract, insurance contract with good quality insurer, get that big brand name behind that insurance contract. So, well, before we move on to the next question, sorry, Neeraj, were you planning on saying something?
No, no, I just wanted to add that,
Okay.
only so in India right now, even health insurance and term insurance itself as products are not very penetrated, right? But then beyond this, we also need to start thinking about covering ourselves for accidents and critical illnesses as well. So this is something that all we talk to our clients whenever we engage in discussions with them when we are discussing insurance, whether they really need a critical illness or an accident cover. These two are largely need based, instead of if it's not really mandatory for everyone, depends on a lot of factors. That's why it's need based, but people should think about these two as well.
Great point, Neeraj. I think risk can come from all sides, so it's better to be prepared and insured. Um, so, uh, before I move forward, I just want to again quote Robert Kiyosaki, the author of Rich Dad Poor Dad here. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. And I say this because estate and will planning often gets overlooked in financial planning discussions. And so, Neeraj, my question to you is, can you share some details on what you think is essential for effective estate and will planning, so that your next generation, you don't leave a mess behind you, you actually leave an inheritance.
So, when it comes to will planning, right, you need to really assess what kind of assets you have and how many people are going to claim your assets, right? So, number one, if there is real estate, I think it becomes even more essential to have a will in place because there's no concept of nomination in real estate, right? If death happens, then people have to go to court, get legal hire or succession certificate, and then get the real estate transferred to their name. So, it's always better to have a will instead of leaving your descendants in such hassle. And then as far as financial assets are concerned, uh, you need to assess whether if there is only one claimant or there is more than one claimant. Is there going to be a dispute if you only leave nomination in place and don't put a will in place, right? So all these things need to be considered, and it's always better to put a will in place where there is going to be more than one person who's going to claim your assets.
Thanks, Neeraj. And I think will making as a process, it's thought to be very overwhelming, where you need lawyers and you need to get registrations done.
Agreed.
But a will can be as simple as just writing it on a piece of paper and having two witnesses sign there and then itself.
Absolutely, absolutely. It's fair, very easy. You can just put it on a piece of paper. You don't even have to get it registered. But
Yeah,
if you can get it registered, nothing like it.
yeah, yeah. So, as we near the end of this discussion, I would like to just ask both our speakers to maybe talk about a few key financial metrics that people should keep track of for long-term financial well-being. Kirtan, can I ask you to take this one first?
Uh, Animesh, for me, this is very simple and rule based. I think if you don't draw uh, uh, a line of what is the difference between need and wants for you, you will never be able to keep a watch on anything in terms of finances. So, what I follow is a very simple 30-30-30-10 rule, right? And that's what I, in general, discuss everywhere. And this rule is pretty simple, right? That if you've got 100 rupees of income, make sure that your expenses don't cross 30%, your EMIs don't cross 30%, and make sure that you save 30% slash invest 30%, and you keep 10% for contingency or liquid, whatever. So say if you are somebody who either does not have a home loan or your home loan is over, then the 30% of EMI then gets clubbed into investing. So you do 30% of expense, which includes your lifestyle. You do 60% of investing slash saving and 10% liquid. Of course, by doing this, I'm not saying that you actually compromise on your lifestyle, don't live, stay very very closed, but largely if you follow this, and if you're or I would say largely if this comforts you and you are happy with that kind of lifestyle, this is one metric that can help you understand whether you are overdoing something or not. So the day you cross any of these figures on a higher side, you know that probably things are not correct and you probably have to go back to the drawing board and restructure.
Yeah, and it's very simple to also keep track of. For example, if you go overboard with expenses one month, you know that you have to cut down below 30% expenditure the next month. So I think that's very practical tip. Thanks, Kirtan. Um, Neeraj, can I ask the same question to you? What are some key metrics that one should keep track of for long-term financial well-being?
So best thing to do as far as improving your finances and meeting your long-term financial goals is probably focusing on increasing income rather than say reducing expenses or chasing returns, right? Because uh, you really need to, if you have to chase returns, you need to spend time on that particular thing to make sure that you're doing the right thing and you are creating generating alpha there. But if you can focus on how you can learn more in your core job and focus on increasing income there, that can more than compensate for the lower returns that you will generate in something that you don't even know about, right? So the data clearly says, right, more than 95% people don't really make money in trading. But why do they trade? Why do they spend their time in trading, especially from 9:15 a.m. to 3:30 p.m. when they have to be in their offices and work, right? So this is something that I could figure out early in life, and I've been, successfully able to do it. And also, we tell this to our clients, right? You don't really have to bother too much about returns. Just focus on increasing your income, and you will meet your financial goals with a lower return as well. And then second thing that becomes important is obviously understanding the risk of different products, right? Just because your neighbor got rich investing in something, say, take the recent example can be small caps, or before that crypto, does not mean that you will also be able to do that, right? And betting your house on that does not make sense. So apart from understanding the risk in the financial products, also understand your own self and the kind of risk that you can take, right? Some say, for example, even though I understand equity as an asset class, I may not be comfortable in investing in small caps, right? I could prefer large caps because of the inherent lower volatility. So all of these things become extremely important when it comes to your long-term financial planning and understanding your own finances.
Thanks, Neeraj. I think understanding yourself first, that is the beginning of attaining financial well-being. Um, so I know you guys spoke about a lot of practical tips, but just to summarize our discussion, now that we are at the end of this 1 hour session, um, can you guys maybe summarize the top financial lessons that you have learned through your experience with clients, through your own personal experiences, just so that everyone has a few key takeaways from this discussion? Um, can I ask Keertan again to go first?
Um so Animesh, because this is more on financial planning, I think there are two, three things that I really want to highlight. But before I say that, I just want to make sure that all of us keep talking about investing, but one lifestyle thing that I really want to tell everybody is that there's no point of living like a poor and dying rich. So while you do all of these things, don't compromise on your basic needs or lifestyle related things. Of course, there are reasons why you should do financial planning and all of these, but there's no point dying rich. So do enjoy your life. But having said that, I think two three things that people should know is first, or my learnings are that a lot of us in the hindsight understand that had I started early, it would have been uh, so much good and all of that. So if there are people who are extremely, or people who are young here, uh, and if you are listening to us, start your investing early. And even if you've not started and you are in the mid 30s, late 40s, it's not a bad time to start. Start as soon as you realize that you have to start. One, um, take risk management more seriously and solve that problem before you move to investing. So I think all of us should have a term insurance, have a mediclaim, and like Neeraj was saying, not depend only on your employer. While your employer might give you that, make sure that you have much more than what your employer gives you. So have your risk management in place and then concentrate on building a portfolio and investing. And the last is, in this race that all of us keep talking about, don't forget that reaching your goal is more important than generating higher returns. So I think these are the three things that I want to send as a message at the end of the conversation.
Yeah, enjoy the journey and don't worry about achieving the goal. Neeraj, can you
So
go,
a
please?
couple of things that I want to add here is number one is you have to always plan conservatively, right? You can position yourself aggressively, but always make your plans in the most conservative manner so that all sorts of unforeseen things can be factored in, right? And if any financial planner is making the plan in a very aggressive manner, that itself should be a red flag, right? raise questions. That's number one. And then number two, like I said initially also, always try to have a balance between everything, right? Balance between your long term goals, short term goals, your loan repayments, tax saving, liquidity. Don't go aggressive on goals itself, right? You can't really create say 5 to 10 goals, but your income can only support a couple of goals, right? So you also need to prioritize these things. And then if you have a financial plan in place and you trust your advisor, try to implement the plan, right? Just having things on a piece of paper will not help you nor your advisor, right? So this is something that has been lacking a lot, that people don't really implement for the longest periods of time, and you have to chase them to make sure that things get implemented, right? So for you to implement also, you need to trust your advisor, and if you're doing it yourself, then write it on a piece of paper and start implementing all those things.
Very true, Neeraj. Consistency is the key for achieving financial well-being, and the best investment that we can make is in ourselves. So I'll just leave everyone with that thought. Um, I'll hand over to Akash now. Thank you, Kirtan. Thank you, Neeraj, for this lively conversation. Some very great points, some very practical tips. Um, Akash, all yours.
Thank you, Kirtan. Thank you, Neeraj. Yeah,
Yeah, thank you so much, Keetan and Neeraj, for taking your time and sharing the valuable lessons here for our audience. I am sure this spaces would be very insightful for our audience. So thank you so much.
Hey, thank you so
Thank you,
much for having
everyone.
us. Akhil, Animesh, Akash, thanks so much for having us.
Thank you everyone for
Thank
joining
you,
us
everyone. Thank you,
today.
Akhil, Animesh.
Uh,
Bye.
yeah. Also, if you're looking towards your financial planning in a holistic approach, we at One Finance follows a similar approach towards financial